Now, you say the market is starting to pay less attention to rhetoric that we've been hearing from Washington. What does that mean and translate through for investors?
Hi, Brad, and thanks again for having me. We just noticed how the reaction of the markets has started to diminish some when it comes to the big statements, and whether it's through social media or through some of the faces you see on the news shows and political back and forth. We just don't think the reaction is as vitriolic as we saw, over the past couple of weeks. And the market's starting to grasp what is happening. The proverbial sausage is being made, and getting its arms around an administration that had a totally different take on how to handle these situations as far as the public-facing statements. And there's a bit of adjustment that had to happen. But we don't see the reactions of the previous couple of weeks continuing as the back and forth about trade continues to progress with us in China, the North American back and forth that we've seen as well. So we're moving past that. The market feels like it's starting to get more of a grasp on the cadence of this trade rhetoric, and we think that coming forward in the next couple of weeks, that will continue to diminish.
Do you think that cadence, even as the markets are trying to best anticipate what that cadence looks like from here, that there's still the potential for a volatile reaction here from what we've seen in some of the tariff announcements or even the broader economic impacts of immigration policy?
Absolutely. There's always the potential for a negative reaction. We feel like the rhetoric is starting to, the reaction from the rhetoric is starting to diminish, but when the policy starts to take shape, that will still, of course, move markets one way or another. But we're seeing the market start to decide between the rhetoric evolving and what's turning into policy. And the former will cause intraday moves. The latter, of course, will dictate where we go the next couple of years and be a little more impactful to market direction. But just the day-to-day rhetoric is being looked at as being perhaps not how the policy will end up, and that's critical, we think, over the next couple of weeks as the market starts to get its footing behind earnings.
And so, Keith, while we have you here and we're talking about earnings, we got, of course, the best barometer for retail, perhaps, at least in the U.S., with Walmart reporting here today, and them having a clear line of sight into how consumers are still purchasing everything from groceries to some of the discretionary spending. What are you seeing as a pull-through, perhaps one of the denominators about the consumer through an earnings report like that?
That's a great question. Walmart is a holding we have, and we look at this name as a stalwart of not only where the consumer stands, but also inflation and as a hedge in an interesting way. As they picked up more customers, that they define the more affluent customers, those making an income of over $100,000, that traffic has continued to improve, as we saw started to happen when inflation really reared its head a couple of years ago. Walmart is also in the process of monetizing traffic through its app. Also really pushing forward on the delivery experience, whether delivery at home or to the car, where that also gets captured within an e-commerce business, but is still growing at a clip that is impressive. What happened to Walmart, in our opinion, is the valuation was well north of the market because of that execution they have displayed over the past couple of years. And the stock has been rewarded for it. And the sell side and buy side assumptions had moved north of where reality of the company had grown. So the anticipation and frankly optimism about the company had probably moved a little further than the story had developed. And we're still comfortable with the execution of the management team. Highlighted inflation being perhaps a limiting factor this quarter in the grocery space, and that's not necessarily anything that we didn't feel like was warranted. So, Walmart, in our opinion, is still a company that executes at a very high level. Again, gives us a read-through to the consumer, but also picks up flow of traffic of customers, frankly, that haven't shopped at Walmart in perhaps a decade or so. So we're really excited about the story. The valuation, again, is rich, and today offers an opportunity perhaps to get more involved.
It sounds like it's still one of the top picks for you and the team here. Another one of them is Delta. Take us into your thinking there.
Sure. Delta's riding a wave of travel experience that we saw pick up in a very material way right after the pandemic really started to wane, and really had to slow down. And we've seen flocks of people coming through TSA turnstiles, and we have data on this on a daily basis. We're running well north of the best traveled year, which was 2019. At the same time, we've seen fewer, worldwide carriers. Now it used to be 7 or 8, 15 years ago. Now it's 4 big global carriers that now can have a little more discipline as far as what routes are or have how much capacity, and have a lot more sustainability to fares that we've seen have inflated over the course of the last 4 or 5 years. Delta specifically still has the business travel component. It's actually shaped itself into being more of a luxury carrier. The business component is still coming back, but we've seen pay down of debt now, the investment grade quality debt, and the cash flow they're generating right now really bodes well for the continued traffic we see coming through air travel here in the U.S. and internationally, and also the capacity to be able to keep prices sustainable and actually moving higher to capture more of that marketplace. So we're really excited about the opportunities that Delta shares offer our clients as well.
Keith, thanks so much for taking the time here with us today. Appreciate it.
Absolutely. Thank you.